Greetings, everyone. Keith Prather with NCM, and this is the Farm Equipment Economic Outlook. I'm showing you the demand index. So this is the NCM demand index, and right now we're finally starting to get a little bit of optimism in the index itself. So it moved up a little bit in January to 60.3, so it was about 0.7% higher month over month, but still remains about 9.3% lower year over year. So we still obviously are seeing some sluggishness. And against the long-term trend, obviously we're still a little bit weaker than expected. Now, I will say in almost all of these charts, one of the things that is positive is, in the industry, I still hear when I talk to folks that we're still seeing sales and we're still seeing business volumes that aren't terrible. And that's because if you look at the index itself, historically, it still remains at a pretty high level compared to where we were in the decade prior to the pandemic. So there's still opportunities out there. They just may be a little bit fewer and far between. As we look then at the second index here, if I can find it. So the industrial production number, though, shows that the industry is still staying pretty conservative with how much inventory and what they're building and what they're bringing online. We still see it. It was about 0.3% higher month over month, but was still 7.3% lower year over year. So it's still off the long-term trend. Still see it below and a little depressed off of that. But I think we've got some interesting dynamics coming up that are going to make this a really chaotic but a very interesting year ahead for the farm equipment industry. So a couple impacting headlines. So this year, we know that for 2025, there's going to be about $35.7 billion that's going to be pushed into the farm community for bailouts that stemmed from losses in 2023 and 2024. Now, a lot of that money is going to have to go into repaying debt, paying down some of the borrowing that was done over the last 2 years to recover from losses. But doing an analysis of that 35.7 billion, we still believe that there's going to be somewhere between 2 and about 3.2 billion dollars for equipment purchases. And so a lot of this will be upgrading current equipment. A lot of it will also then be, maybe purchases of new equipment. We don't know if there's a 50-50 ratio there, but there's going to be significant new funds available out of that 35.7 billion that would sit on top of normal annual spending in an environment like this. So we take last year's spending volumes and we could add 2 to 3 billion on top of that, and that's more or less what 2025 is going to look like. Now, the way that money is being, partitioned out, not as much to smaller farms. So average 125,000 to about 250,000 per farm based on size and number of acres being farmed. So when you think about some of the big purchases, new combines, some of the big, heavier, higher end equipment, you may see less activity there than you will in maybe some of the smaller, medium range, mid-sized type of equipment. So farmer sentiment is slightly a little bit better. I'll show you the Purdue barometer here in a minute. And so there's some optimism about next year, but what we're really watching coming up beyond the bailout funds and probably a new farm bill is what happens with tariff risks. So a couple different things. I don't have it in here, but we know that steel tariffs and aluminum tariffs are going to be an impact for the industry. In most industries, we're seeing anywhere from a 3 to 4% retail price increase just based on the rising input costs from steel and aluminum tariffs. Again, those haven't been fully applied. We'll look and see in about 4 or 5 days, whether the Mexico and Canada 25% tariffs stick, and then more importantly, what exclusions are granted. So in the 2018-2019 period, the Trump administration granted somewhere around 18,000 tariff exclusions at the time. And there were some input costs, input material costs that got exemptions for the farming community. But the problem was that at that period of time, retaliation by China and by several other countries led to losses of about $27 billion for farmers in that 2018 to 2019 period. Now, the Trump administration backstopped that and provided about $28 billion in relief for farmers. But the problem is that a lot of the sourcing by China, by Mexico, by some of those countries that were buying a lot of US farm commodities, a lot of that sourcing shifted and some of it permanently shifted. So pork was among some of the hardest hit, and that diversion of sourcing by China to alternative markets like Brazil, Argentina, some of those other markets has still not returned nearly 5 years after those first tariffs and that retaliation started. Soybean sourcing, same thing. Brazil, Argentina picking up the majority of a lot of that shifting. Now, I only bring that up because I think what will be part of the new Trump plan, okay, as he goes into these negotiations with a lot of these countries, especially China, Mexico, Canada, is that, for instance, in Mexico, Mexico shifted a lot of corn and soybean sourcing to Brazil and Argentina. One of the things that he could do is say that he could ease the 25% tariffs, but he wants to see some of that sourcing come back to the United States in return for that. So he'll give them recognition for or compensation for them changing their sourcing policies, which could actually help the farming community. But it's going to be a real interesting negotiation. So I bring this up for a couple of reasons. I don't want you just honestly, immediately think about that 27 billion in retaliation that we lost in 2018 and 2019 and think that we're going to see the same playbook as we go into 2025 and we go through this year. It may not look that way. Again, the art of the deal, he's going to be negotiating, and right now the farming community is kind of, high on his list of elements in the U.S. to protect. So he knows he's got a big issue there. He's got a new ag secretary that I think understands the plight of the family farm. And so I think you're going to see some movement there. And hopefully it drives even more activity beyond just this, input of another $2 to $3 billion of available products or available funds. So here's the capital investment index that I watched the closest from Purdue. It slid a little bit sideways month over month. It didn't change. Still at a reading of about 48. We'd love to see that above 50, but it is an improvement over where we were late last year. So we do see optimism about investing in farm equipment rising. And so we hope that continues upward. Now, again, I think tariffs are weighing a little bit on what farmers are feeling, and they're going to be watching commodity prices. And commodity prices in 2025 are expected to be fairly flat or maybe slightly weaker, depending on what happens with tariffs and retaliation and those things I just talked about a minute ago. So that's primarily it. I mean, we have a machinery forecast that we've developed. Some of this is ag, some of it's transportation. And again, this is a data-driven, not Keith's opinion or my team's opinion of what's going to happen with overall machinery demand and machinery manufacturing. But it does show all the demand factors that kind of go into this model do show an uptick, and they show improvement throughout the year and well into 2026. So we think, again, if you look at it on a historical basis, you see that improvement here. So it's a sharp rebound, sharper than we've seen, maybe going back to the 21-22 period when we know demand was pretty strong, but maybe even returning to levels that we saw in 2017, 2018, in that period when we had a pretty decent demand environment. So overall, that's kind of what we're looking at. Again, there's a lot of moving parts, a lot of things that are going to have to go well. We are going to have to watch those tariff negotiations very closely. And then there's other factors that I didn't talk about in this particular video that we do in the others, which is, we're watching treasury rates, which affect long-term borrowing interest rates. We're watching delinquency rates. There's some things in there that are part of the mix that we do have to continue to keep an eye on. Now, right now, they're not a huge problem, but they could be in the future. So again, we're going to have to watch that and kind of keep an eye on it. But generally, watch for that 2 to 3 billion and see if that creates what we call animal spirits in economics, where you start to see some investment and some spending and some green shoots of activity kind of popping up in the first half of the year as those funds start to hit the street. So anyway, I hope everyone is doing well. Look forward to seeing you next month, and be safe out there. All right, take care.